we're going to try and make sense of some of the tumultuous market dynamics that we're all struggling through with my esteemed colleagues here today. If you roll back the clock 12, 15 months, the world really changed. Coming out of the pandemic, the liquidity bubble that all the global central banks had created started to pop. The riskier assets, whether it was Bitcoin, biotech stocks, technology stocks, started to plummet as central banks, the US probably most aggressive, but globally on a coordinated basis, started to raise interest rates quite dramatically. We then move into a Russian invasion of Ukraine, injecting geopolitical risk that I'm sure very few of us in the room ever imagined that we'd be living through another land war in Europe. And then most recently, the collapse of Silicon Valley Bank and Credit Suisse. It's enough to keep your head spinning. So what we're going to try and do over the next 45 minutes is make a little bit of sense out of it and help chart a path going forward. So my guests, as indicated, are Richard Falkenrath, head of geopolitics at asset management firm Bridgewater Associates, Carol Jeremiah, who is president and head of global distribution for MFS Investment Management, Mark Wiseman, the chair of AIMCO, and Allison Lote, managing director, head of sustainable investing and innovation at OP Trust. Thank you all for joining us today. So Mark, as you're at the end, why don't we pick on you first? You wear many hats, leading a pension plan in Canada, formerly head of the largest pension plan. You advise many financial services companies. What's your perspective on the investment environment today? What are you worried about the most, and where do you see the best opportunities?
Well, thank you, and I'll just take 39 of the next 40 minutes to answer those 7 questions that you put into one. Let me just maybe boil it all down to 2 very, very important fundamental factors that's changed. I think it's fundamentally changed, and I think you heard a little bit about this on the last panel. But 2 things have really changed from an investor's point of view. Because remember, investing is about return, but it's also about risk, and you have to assess those 2 things. And actually, both the return element and the risk element has fundamentally changed in a way that is exceptionally different from what we've seen for the last 2.5 decades or more. First, on the risk side, geopolitics matter, and they matter a lot, and I'm not just sort of speaking the Eurasia book here, but never before, at least in my investment career, have geopolitics mattered to outcomes as much as they do today. It's about decoupling. It is about the relationship, sort of the extension of that, the ongoing relationship between China and the West. It is about a war that is taking place in Europe, but from an investor's perspective, not just what's happening on the ground, but all of the derivative effects that has on markets, including markets for energy and commodities. It is what is happening fundamentally in the Middle East, and the way that businesses and the economy is reorganizing itself to deal with all of those elements. So as an investor today, whether you're investing in equities or fixed income or infrastructure or real estate or private assets, you cannot do your job without being an expert and understanding the geopolitical implications of your investments. And I didn't even get to energy transition because I know that Allison will probably speak about that. Secondly, and equally importantly, is the fundamental change that we're seeing in the rate environment, driven by inflation, highly persistent inflation, inflation that is structural in nature and very, very hard to shake. We are seeing major moves that are going to continue in terms of the risk-free cost of capital. And again, that has implications all the way through the system. When you change the risk-free rate, every single asset ultimately reprices and capital allocation moves. Those two things alone change everything. It changes the way that investors are going to allocate capital, it changes where you're going to find return, and it changes the risks, both perceived and real, in markets. So I'll stop there, but I would just, maybe the last thing I would say is, in my kind of 25 years as a professional investor, right now is by far the most complex time that I've seen, far more complex than the global financial crisis, because everything is different.
Thanks, Mark. Some great thought starters, and clearly reflects what I believe a lot of us are feeling with respect to the environment. And actually, maybe, Richard, a perfect segue to your focus, which is the geopolitical arena. How are you thinking about those dynamics, whether it's the European land war, perhaps a new Cold War between the US and China, and we heard earlier today some discussion around the challenges to democracies in developed countries. What are the elements that you're focused on in your organization, and how's that shaping the investment perspective in at Bridgewater?
Thank you. It's a great question, and thank you for the invitation to be here. And I think Mark nailed it. I mean, the focus on risk and return and how they are shifting is exactly right. I'll double click into the risk part of it for just a second. Bridgewater deals with it at many levels, from the most micro-technical level of like skew and implied volatility of options contract, all the way up to the highest level, which would be geopolitics. And on geopolitics, I think you're opening, Alan, had a deep insight, which is a land war in Europe. None of us would ever thought we'd see that. And what that is to me is suggestive of a basic cognitive bias for recency. So we all tend to think the thing that's about to happen in the future is most like the thing we've just lived through in the past. And in our case, everyone in this room, have lived through a period of extraordinary, anomalous global peace and consensus about what that meant. And that is now under assault from multiple directions. And I think the green transition, hugely important, the AI revolution, hugely important, the long-term debt cycle, hugely important. But the biggest, I think, on the geopolitical side is China. It's not Russia. Russia is like a house fire. China is like an earthquake, what's happening here. The rise of China has been foreseen for a long time, known this was coming. And we, the international community, made a bet on how to deal with it, which was essentially integration, engagement, hoping that it would moderate and accept the rules of the road as defined by the post-war Western consensus. And it didn't work. And now we are in a much more fundamentally antagonistic view. And I think the world is slowly reorganizing and shifting to a containment posture, which is far more complicated than it was during the Cold War because of the hyper-entanglement of our economies and societies and the velocity of markets and technology. And so that, I think, is the single biggest geopolitical phenomenon. There are many others, and like the Gulf, and I mean, there are many others too, but figuring out how to deal with China in a world where there is essentially open hostility and opposition to the Western-defined rules of the road, rather than constructive engagement on global issues, I think is the foremost geopolitical question of our time. And it has, as Mark says, a huge impact on how you need to manage your investments around the world and your lives.
Thank you. You've actually both touched on energy transition, and don't worry, I'm going to come back to both of you on China as an investment opportunity, so think about that, please. I want to shift to you, Allison, because they touched on energy transition, and you've heard a lot today about climate, right? This is front and center for you. As you think about an investment theme that didn't exist 5 years ago or 10 years ago. Talk to us a little bit about how you're thinking about climate change, how that's impacting the investment plan for your organization, and how the rest of us could maybe be thinking about that.
Sure. Well, if Richard and Mark didn't have you running for the hills with the complexity of the world, you might, after I describe a little bit about what the climate crisis is going to mean for all of us as citizens as well as investors. in a way, a little bit, and Richard, you mentioned this, right? We're all guilty of sort of interpreting the world by what we saw last week. What is particularly challenging, I think, for all of us, and particularly in investment organizations, is that we haven't yet understood or lived through what we're about to live through, if we believe the science, which I do, of climate change and what that is going to mean for every single industry and geography in which investors work today. If you cast your mind back to your sort of Econ 101 course, you'll remember the concept of externalities. Most investors have been trained, whether explicitly or implicitly, to think about climate and its impact as an externality. It's something we don't pay for, we can kind of put it over there. And that is just simply no longer the case. So there is a sort of quiet and I like to think very serious revolution going on in all of many investment organizations who are trying to grapple with this in what is very unknown. So for context, I manage the sustainability team in one of Canada's pension plans. So we're a very long-term investor. Our liabilities go out 40 years, and we have to be thinking about our investments in that time horizon. So I'll pick up, Mark, just to get more tactical about how we are starting to change the way that we do invest. Risk and opportunity, and this is really the heart of it. So there's a whole bunch of ways we have to start assessing climate risk that we've never done before. The tools don't exist, the data aren't perfect, it's very uncomfortable for investors, and most of all, we have to shift our mindset from one where we see climate as something somebody else pays for, as something that's actually very critical and fundamental. So we think about this from the top of the house. We try to figure out, depending on the trajectory of the warming of the planet, what impact is that going to have on anticipated asset returns? And the headline is it's bad for almost every single asset class. What impact is that going to have on interest rates, particularly in a country, or GDP in a country like Canada and the US, which do have a heavy dependency on energy? So what does that mean for how we construct our investment strategy? So that's one piece. Second, from the bottom-up perspective, tactically going through every single investment and strategy to figure out what impact climate might have. Sometimes in real assets, it's physical. There could be it's in a flooding zone, or name your physical risk. Sometimes it's consumer preferences may change. Sometimes carbon is going to, we know carbon will cost more. So there's a whole bunch of tools, carbon accounting, things that we've just never done before that we're starting to do and build in. More hopefully, though, there's also an opportunity side, and that's what my portfolio is focused on at OP Trust. Typically, though, a lot of sort of climate innovations where we do allocate capital is outside of the sort of risk framework of most pension plans, because we are mature. But there we are trying to be very intentional and risk managed about investing into the climate opportunity, of which the energy transition is just one small part. Agriculture, mobility, all of these verticals are changing massively, and there's a score of investment opportunities in there. It's about picking the right ones. We've got lots of different ones, but they're small, experimental, but we are ultimately hopeful that we'll see the opportunity side of this as well.
Great, thank you. We're going to have to rename this panel the Doomsday Panel.
Yeah, I know. That's why I had to end on hope. And actually, Alan, if I could, just on a personal note, if those of you in the room, when I started at OP Trust, I did not come from a climate background. This is something I've really had to learn, and it is one of the most fascinating jobs I've ever had. So if you haven't yet had the opportunity to kind of work through climate change in your organizations, I hope you will, because it is not only very intellectually fascinating and stimulating, but it's also very sort of emotionally fulfilling. So it is a wonderful place to spend time as an investor.
That's great to hear.
So just to elevate it a little bit for you.
I feel much better already, thank you. Maybe Carol, you can give us a little bit different perspective. You're the bridge between investors, both large and small. How are they feeling? What are they looking for in an asset management firm today? What are the themes that you're seeing as you're connecting with that side of the fence?
Yeah, first, I'm just so glad to be here, and I just want to mention, if you don't know who MFS Investment Management is, we are going to celebrate 100 years next year, but what's really important is Sun Life of Canada bought us 40 years ago. And I have to tell you, I've been at the firm almost 40 years, and I have watched day in and day out, year after year, decade after decade, and just how well a partnership, a cross-border partnership can be. And I'm so proud of that relationship and what we've really been able to do as companies together. So anyway, I'm so delighted to be here. I guess, one of the things I am hearing from clients a lot about is that they're burned out. We are clearly in a polycrisis, as everybody's calling it, and the odds of this all happening at the same time at once is almost never. And so I think, it's the stress and the being exhausted about dealing with uncertainty that doesn't seem to calm down. And I guess, the way we look at it is this is for us an opportunity where we step in and help. Because as a bottom-up, long-term active manager, we have always stood on the fundamental belief that actually quality earnings, quality assets, the fundamentals do matter. And now that volatility is back, it's actually really healthy. It's healthy for our markets. We are all being reminded abundantly about how important liquidity is as well. And so when I think of the opportunities, first of all, they're massive. I mean, we've just spent a whole morning listening to one of the biggest economic opportunities since the Industrial Revolution. It is real. And one thing Mark and I have talked about, he just wrote a paper on this, is ESG is not political. And this is what we need to educate our clients about. This is not politics at all. This is about how to finance the future and make money for our clients. But the one thing I do think we need to work really hard on with our clients, the public and investors in general, is that we need to have a collective war on the battle of short-termism. Because it's crushing everything that we're doing. And we have to change so much about the system we've all built between the end investor and the public company and all the layers of us holding each other accountable. And as we think about sustainability and net zero and everything about financing the future, there's just a huge opportunity to step in and correct the misalignments that we have, that we all hold each other accountable, but need to change in order for us to allocate capital responsibly. That's what I'm the most excited about. But it is about extending time horizons and realizing that really to put money to work, we cannot be constantly thinking that we've got to beat benchmarks over shorter and shorter periods of time. It's just not responsible, and it's not how we're going to hit the sustainability goals we need.
That's a great point, Carol, and I feel that we see that. And I look out on the room where there are a number of corporate CEOs who are all pressured, struggling to hit those quarterly numbers that we've all established. And much of the investment programs that we've been discussing today are much longer cycle that really don't, as you point out, align with that, and bridging public and private markets to be able to finance these opportunities is really going to be a challenge for all of us, which maybe, Mark, is a great segue back to you in terms of opportunity. And as you think about this group, you've got these shifting themes and cross currents in markets, but ultimately there's capital that wants to be deployed here. Where do you see opportunity, and how do you parse that out, maybe even between public and private markets, and what are your thoughts on that today?
Today I'd recommend two things to invest in. One is 2-year Treasury bills, and the other is consumption. With inflation, buy some good wine and drink it. No, in all seriousness, maybe to bring it back just for a minute. Actually, the 2-year Treasury. Actually, both those things were serious. But just to come back a little bit, maybe to the topic here at hand. This is the time, and Evan Solomon told me that I should be provocative and speak my mind a little bit. This is the time now for North America. This is the time now for the North American market. This is where our comparative advantages are actually incredibly, incredibly valuable. And those comparative advantages are on both sides of the border, but they'll only be fully realized if the two countries actually work together as a single market. We have, in North America, energy self-sufficiency. We have, in North America, access to the world's greatest and most important natural resources, including base metals, that are required for the transition economy that Allison was talking about and where Carol was talking about opportunities. We are in a place where we have a strong regulatory environment. So as much as what went on with Silicon Valley Bank, it got solved, at least for the time being, over the weekend. We have a strong financial system, particularly in this country. We have an incredibly robust banking system that puts us in the envy of almost everybody else in the world. We have human capital here on both sides of the border that is both educated, innovative, and in the case of Canada, growing due to our immigration advantage. So we can either sit there and look at all of these advantages and kind of twiddle our thumbs, or we can get on with it and actually press our advantage with the rest of the world. We are in a competitive world today, and I would say, particularly here north of the border, we have to learn to stop playing for participation ribbons and start playing to win. And the way that we're going to win is by doing that together, cross-border, innovation, productivity, moving people across the border, moving energy across the border much more efficiently, and pressing our advantage. The capital is here. It wants to come here. It's willing to invest here. Let's get on with it. Let's make sure that the policy is aligned with where capital flows want to go. And let's have North America win. Let's have North America win, and let's play to win.
That's great.
Is that okay, Evan? Okay.
The Razor Group is thrilled.
I think there's no better place in the world to invest right now than in this country and in the United States of America. And for those of you who know me and know my investment career, I've been a globalist. I wish the world was more global today. I wish we didn't have the geopolitical issues that we have. You know, I wish that I could diversify my portfolio more easily globally. But right now, given the risks and return opportunities, there's no place like home.
Thank you. Appreciate it. And maybe, Richard, just to follow up on that, I said I'd come back to China. Your organization at times has been quite outspoken in terms of the opportunity there. And while we've seen the most rapid GDP growth of any country in history that they've experienced, it hasn't necessarily been a good place for investors, particularly foreign investors. Do you see any change in that opportunity? And as you think about how people are positioned, is that an area of opportunity that we should be focused on?
Look, the most important principle for investing, or one of them, is diversification and getting exposure to lots of different markets simultaneously. And from that lens, you would be foolish to rule China out of that. But you do have to look in, and there was a world 10 years ago where, 15 years ago, where the international community was extremely optimistic about the trajectory of the Chinese economy and Chinese society, of freedom and openness, the vibrancy of their entrepreneurial class. And the picture has shifted today. And the message out of at least Washington, I don't know about Canada, though I think it's similar, is a much more mixed message. If you go back to the Clinton administration, the Bush administration, which I served, the Obama administration, it was almost without qualification an endorsement to Western business interests and capital flows to invest in China, to move the supply chains there. Very few controls, if any. And now what you've got from governments is a totally mixed message, which on the one hand, trade continues to grow and FDI continues to happen, but the government couldn't be clearer that the political environment has shifted. And so I'm back to the doom and gloom part, away from this great optimistic part that we'd started on. And I think what Mark said was brilliant. You just have to remember that the global order that we have, the markets that we have, are the function of geopolitics. I mean, the causal arrow goes from geopolitics to markets, and the structure of markets and the structure of the world order. The European Union, outcome of geopolitics. Integration of Japan, outcome of geopolitics. NAFTA, outcome of geopolitics. The dominance of the dollar, outcome of geopolitics. So the big, big forces that shape the economy over decades and centuries, the global economy, are geopolitical in nature. And that's what we're potentially dealing with here. Private industry, capital investors, asset allocators are struggling with trying to figure out the answer to this, because from a diversification investment point of view, you absolutely should be there. But at the same time, you've got to read the signals that you're getting from the political side of our countries.
Thank you. A really great perspective. And maybe I'm going to come back to you, Carol. One of the other topics I thought we should cover is, we grew up in a world of 60-40, right? equities, bonds. Both of us have seen in our lifetime the growth of alternatives as part of that. How do you think about asset allocation decisions, and how are institutional investors rethinking that perspective, particularly as Mark points out, in a world where you can actually earn a decent return on cash again? How are you advising people, and what's that dynamic like?
Yeah, well, one thing that with an organization like ours, it is about a bottom-up approach to long-term investing. And what I talk to a lot of clients about over and over again is you just look at the past 30 years, and investors have had to take 5 times the amount of risk to get the same amount of return that they do now. So when you think about asset allocation decisions and the pressure of our clients and asset allocators, so much complexity is now built into the model that used to be a really simple model of a 60-40 split and maybe even a good chunk of cash. Now, obviously, that complexity may be coming off a little bit because there's other places to go. It's no longer just TINA, no other alternative. But I don't think the complexities go away at all. And I think what I would say is this really comes down to a world that allocation of capital is going to change completely going forward than what we've seen in the past 30 years. And one of the things I would say, and obviously I'm biased from an active manager, but first and foremost, we need to look at the limitations of simply making investment decisions based on risk exposure and not really knowing what we own. Those days are gone. We absolutely need to understand the businesses we are investing in. We need to commit capital longer to these underlying businesses, and we need to engage with them way beyond proxy voting. And what really, when we think about sustainability and ESG and everything that we're talking about, what we're doing is redefining what active management, long-term active management, should be about. And the stewardship role that we all play in terms of owning companies. I heard a great line from a European pension investor that said, you know, and it was kind of a Chatham House rule environment, so we were pounding the table on a lot of things, and he said, you know what I worry the most about is that the industry has gotten really good at moving capital, but not investing in it. And when we think about just our asset allocation decisions, it's all about moving capital around risk. I understand that's an important element to it, but to not really deeply understand what we own is, I think, why we're dealing with some of the negative externalities that we have today, because we were forced to take on so much risk. So as we step into the future, there's a huge opportunity to think about asset allocation differently, think about passive versus active, and instead of them against, the different component roles that they play, and the same with public and private liquidity and less liquidity, and bring that together in more of a holistic view versus competing parts.
That makes a lot of sense. Thank you. That's great perspective. Allison, let's go back to you. You've heard a lot on this panel about timeframes and opportunities, and it feels like you're sitting right in the middle of that with climate and energy transition, and obviously sitting at what should be patient capital, the perspective around the Canadian pension plans. Do you feel that your capital base is aligned with this opportunity? And as you look out, how are you parsing out the opportunities from metals to electric vehicles to batteries to the range of investment opportunities? How are you framing that in a way that's manageable for you and your team?
Yeah, you're absolutely right. I mean, climate change is a very important example of why what Carol is saying is so critical for all of us, and this is policymakers and investors. And that's really about aligning time horizons and incentives much more clearly. Prior to starting this life, I used to run a democracy think tank, and people say, what does democracy have to do with what you're doing now? And it's actually shockingly similar in how taking an increasingly short-term approach actually costs us a lot more in the long term. So I'm sitting in the exact same nature of the problem, just in a different industry. So in theory, pension plans are actually perfectly positioned to thoughtfully tackle how to integrate climate considerations. But the reality is, not every single dollar we invest is oriented in a long-term way, and that's something I think we're all conscious of improving over time. increasingly, and I think, Mark, I know you were a big part of this on Ontario Teachers, increasingly our asset mix is moving to more illiquid allocations, in part because we think that allows us and enable us a better ownership stake and a better ability to actually drive some of that sort of long-term capital allocation, ideally. In terms specifically of kind of some of the opportunities and is capital aligned, I mean, I think the short answer is no. I feel like I see a report every other minute about the, name your trillions of dollars that's going to be required for just the energy transition alone, and we all know that we're nowhere near making those investments. And I will say, for 3 years, I've been running in a portfolio looking to invest in these opportunities, and finding the right opportunities with the right kind of risk management profile for a pension investor is not as straightforward as I would have thought. Even though we all, don't want to admit it, we all care about track records, and when it comes to climate investing, there's not a lot of track records. And we have a lot of governance around our dollars for good reason, because it's not our money. And so it's actually been a lot trickier than I thought to find the right partners in which to invest. That said, there are some incredible opportunities. So just to name a few areas, I mean, you talked a little bit about mobility. I mean, there's a whole value chain around the electrification of our transportation, whether it's ferries, buses, deliveries, cars, you name it, bikes. So there's a whole bunch of stuff happening there, and all parts from charging stations all the way through to kind of the manufacturing of and toll roads and how we manage those. So that's kind of one big category. There's a ton around the energy transition. I know there's a lot of people in this room that think a lot about that. I'll just kind of highlight a couple of things. I mean, one is grid stability. I mean, that especially as we move to more renewables, as well as technologies that actually allow us to better manage our usage of energy. I mean, we just installed a heat pump in our own home, and we can tell every day how much GHG we've reduced and how much money we've saved, and it's actually really quite motivating. And Enbridge, if you live in certain cities, is offering redeeming you for doing this. So, we need a lot more of that. That's back to the policy as well. So there's a lot in there. Agriculture is another massive industry that needs to transform. It's one of the largest emitting. Water usage, there's a whole bunch of things in there. And then maybe the last one, well, there's many more now that I'm rolling here, but maybe I'll just stop there, because there's just so many areas we're looking at. Actually, maybe the last one I'll just talk about is what I'll call business model innovation. And that's really how we move from single use to multi-use of stuff. We just throw out way too much crap. We buy too much stuff. And so we're actually investing into new business models. I'll give you, this is a very small example, but any parent out there will know how often your children outgrow their bikes. This is very micro, but there's actually a growing set of businesses around bike recycling and a lot of technologies to enable us to better recycle more efficiently. So there's a whole bunch of opportunities in there we're also looking at. So that's just to name a few, hence why there is a case for some optimism and excitement, but there's lots more capital that needs to flow to facilitate the transition that we do need to see, not just in energy, but in many other industries as well.
No, that's outstanding. Thank you. And I hope everybody wrote down, buy a heat pump. Everybody?
Well, I'm a big
Ordering
fan
a
of the
heat pump
pump
online?
Neat.
We've got a little bit of time left. Mark, I'm going to come back to you and move across here. A subject I'd like to touch on is velocity of money. I think we're all stunned that $42 billion gets withdrawn from Silicon Valley Bank in one day. Yeah. $100 billion withdrawn from Credit Suisse accounts. I forget if it was a month or a quarter, but the sheer velocity with which money is now able to move through systems and the speed with which decisions are made. As you think about that dynamic, what are the things that worry you? Where are the parts, the latest focus seems to be on commercial real estate, either as it pertains to US regional banks or just collectively for the whole sector. How are you thinking about that dynamic and where are the landmines that you worry about perhaps?
Well, the thing about crises is they wouldn't be crises if you knew about them in advance. When you have an environment like we have today, which is, we talked about at the very beginning of the panel, both high degree of geopolitical risk, rapidly rising rate environment, you have unintended consequences. We saw it with the LDI issues in the British pension funds. We've seen it with the regional banking structure in the US. There will be other unintended consequences as we have this regime shift from a low rate and a persistently low rate environment to a rising rate environment, and perhaps a reasonably persistent higher rate environment. When you have that regime shift, things change. So it may be CMBS, it may be something that we're not even thinking about. But I don't see the velocity of money and the advent of technology as being a bad thing per se. I actually think it's a good thing. It allows us to manage risk better. It allows us to monitor things much more easily. But we have to put the systems and processes and regulation in place that keeps up with that modern world. And I do worry that with all of the advent of technology, the place that probably regulators and I dare say boards of directors of financial institutions, including pension funds and asset managers and other asset owners, is actually operational risk. So quite apart from the investment environment or the geopolitical environment, the operational complexity of systems today is something that I think we are ill-equipped as regulators and as governors to fully understand, and I think we have to spend more time on that. That doesn't mean it's a bad thing. It doesn't mean we should be Luddites and we should all go back to filling out deposit and withdrawal slips. It just means that we have to change our regulatory governance and oversight practices to keep up with that new world order. And we saw that with SVB. Just again, as you said, the velocity of change, and that so we've got to keep up with that. So I do think if there's one place that I worry about, it is the operational risk in the system. And we can talk about cyber risk and all the rest of it. Yes, but stuff breaks when it's complex, and we have to make sure that we have the sufficient resiliency to ensure that it doesn't break.
Yeah, that's a great point. Maybe, Richard, I'll put you in a little bit of the hot seat here, because while, as Mark points out, it's very hard to anticipate a crisis, the reality is that's ultimately what you're expected to do, right? To anticipate where the flare-ups are going to be coming from, and anticipating, predicting, or positioning around that. You talked about risk management, diversification being part of it. As you think about the coming 12 months, are there particular areas that you would highlight as opportunities and other areas that you would highlight to avoid or be wary of in today's market?
I'm not going to address it as an investment topic, but functionally, I think the area in the next 12 months we're most likely to get surprised is artificial intelligence. And we're in a, scientific and technological revolutions are not linear. They're kind of step functions. And we're in a step function. And we don't know exactly where that step is going to go. And what it will do to knowledge industries, what it will do to social justice, and to security, and to risk, and to velocity of money, and just about everything. And so I don't have much to add to that other than to observe that I think this is like one of the biggest question marks for me in the total risk landscape, like right now.
Yeah, that's great. That's really amazing. And maybe Carol, we'll close with you. Where are you seeing money flows, going back to the seat that you're in? Is there any particular product? I know your history is obviously active management, both on all the product side. Are you seeing more money flows in one particular theme or region that would be telling to you?
Yeah, we don't usually see themes per se, or even talk about it that way at the firm. It really is a process of, understanding. Obviously, we don't think it's going to be an easy ride for equities anywhere in the near term. But to us, it all comes down to security selection. The opportunity is now for active management, really, because I think the complexity of everything that we're spending time talking about is where you're going to see the winners and the losers. And the cost of capital is no longer cheap, or it's zero and costing you nothing. You've got lots of challenges of companies. You're not going to just simply financing isn't going to go to every company the way it has in the past. And so I think the security selection of where those winners and losers are going to come out are going to be massive opportunities. So I think from an equity and, of course, fixed income, we just think, you know, there's a lot of good opportunity, but it's security selection, good credits, and knowing what you own and who you're lending to.
Well, that's fantastic. Great to end on such an opportunistic note. My takeaways are going to be that despite the cross currents and the challenges, Mark believes that there's a once-in-a-lifetime opportunity to invest in energy transition in North America. Richard has highlighted AI, and there'll obviously be ways. We will create ways for people to invest in that theme, energy transition and climate. There you go. Allison's already on top of it, and the work that all of your organizations and connected organizations are doing to facilitate that is really impactful. So thank you so much for joining us. Thank you, everybody, for your attention. Hope you all enjoyed your lunch, and onward and upward. Thanks, everybody.
Thank you, Alan.
Thanks, Alan. Thank you.
Great.